Okay, it's 1 o'clock, so let's go ahead and get started today. All right, good afternoon, everybody. How's everyone feeling today?
Good.
Really good.
Good. Yeah, hopefully we're in kind of a, hopefully you guys have kind of reached a lull in the semester now because hopefully all the midterms have been done. So at least we'll have a little bit of break until the next round of midterms. So hopefully everyone's catching up on sleep and kind of taking care of themselves. So over the weekend, I did the adjustments for everyone's midterm scores that they sent me, a revised answer for. So I'm not going to do any more. So don't send me any today or any more. So the deadline's passed for that. So, but everyone that did send me an email, I did get a chance to revise the score. So if you send me an email regarding your question 2 response, then go back and check on Canvas and see if your score has been revised. Just to kind of confirm it. So I don't know if it sends you a notification whenever I change the grades, but I did go in and change all of those. So you can definitely go in and confirm that. Okay, great. Okay, so the plan for today is we're going to continue on our lecture notes for taxes. Okay, so today we're going to start talking about depreciation, which is makes a big impact for your tax calculations. And so, I got a question last night because I think yesterday I posted the new homework, which is going to be due next Tuesday. And basically, what we're going to cover this week is going to give you what you need to do for the last problem on the homework, which regards to taxes. But the first 3 problems, or at least parts of the short answer question in problem 2 and problem 3, you should have everything you need to do that one. But the taxes stuff we're going to learn today and on Thursday. Okay. So before I get started, are there just any questions I can answer? Okay. So let's go ahead and get rolling. Okay, so at the end of Thursday last week, we started going over these lecture notes on taxes, right? And so taxes, I think everyone is kind of familiar with. So just to kind of just recap. So taxes are, it's just say kind of in a very simple way. Taxes are the way that our government kind of funds itself. And the way that it typically does that is it kind of takes a percentage off of any money that you earn, right? So we're strictly talking about just income taxes here. So we're not talking about sales taxes or anything like that. So if you make money, in the United States as a company or as an individual, the government's going to take a slice off the top, just so that it can fund its operations. Okay? But we talk about one particular aspect of taxes that's, really important for businesses, especially engineering companies, and it's this idea of tax deductions. Okay. And so, the idea with tax deductions is that you don't have to pay taxes on every single dollar that you make, right? And so what the U.S. tax code allows you to do is to kind of reduce the amount of taxable income that you make according to certain rules, okay? And so I think the formula that we did before was that your taxable income, okay, the way that you can compute that is that you take your gross income, or basically you count every single dollar and every single cent that you made. Okay. And so, you can think of your gross income, at least as an individual, that would be like your starting salary, right? So, you start an engineering job, you might make 60,000, 70,000. So that number that they give you, when you get the job, that's your gross income. Okay? And so from this, you're going to subtract your necessary expenditures. And so necessary expenditures we kind of went over last time to be things like, things that you have to spend on each year to kind of maintain your business. So these are things like labor costs, so paying your employees, paying for maintenance, right? So maintenance you have to do every single year. And, a lot of times you have to pay for raw materials too. So all of these are necessary expenditures. Okay? And for the purpose of today's lecture, I want to kind of make one more distinction with necessary expenditures. You can kind of think of these necessary expenditures as things that you need to buy for your business that will last less than a year. Okay. This doesn't cover, everything that, business expenses, because, obviously you pay for labor, and, you don't, a lot of times you don't plan on firing all your employees at the end of the year, but your employees do have the option to kind of leave, right? And it's kind of when I say it's less than 1 year, what I mean is that, once you pay that money out, then there's really no way of getting it back, right? So once you pay your employee something, there's no way that you're going to get that money back unless you, have some very, very nice employees. Or, you pay for like a raw material, and you use it up, like you pay for like a big block of metal and you use that up. There's no way you're going to get that money back, at least not from reselling that metal, because it's already used up, right? And so same thing with the maintenance costs. So you pay for, to maintain a piece of machinery. There's no way you're getting that money back, because that money has already been spent to, to maintain that piece of machinery. Okay? And so the other thing that we're going to go over today is called depreciation. Okay. And so depreciation, in contrast with necessary expenditures, these are the tax deductions that you can claim for any kind of machinery or any kind of large equipment that lasts more than 1 year. Okay. And so a lot of the, our economic analyses that we've covered up to this point involves some kind of equipment and large machinery that falls under this category. Right? And so like we did a lot of examples where like you bought maybe like a pump for like a power plant or something, right? So you buy a pump, you pay like $50,000 for it, right? You can get some of that money back. So like we talked about the idea of like the salvage value, right? So you use the pump for 5 years and you salvage it, you sell the parts, and you get maybe $10,000 back. And so for these kinds of equipment where, it still retains value, each year that you use it, I mean, over time it's going to lose value as you use it up, right? But the fact that it can still retain some value to you, and you can get some money, you can kind of liquidate that asset by selling it. These kind of follow some different tax rules than the necessary expenditures, and that's what we're going to talk about today. But just kind of one big recap from last time, once you compute your taxable income, the amount of taxes that you actually pay is the product of the taxable income multiplied by the tax rate. Okay. Okay. And at the very least, your tax rate is going to depend on what state that you live in. But at the very least, no matter what state you live in, you have to pay the federal tax rate. Which for this class, we're always going to assume it to be 21%. Okay? And so you take 21% of your taxable income, and that's how much taxes that you're going to pay. Okay. Okay. Any questions on this so far? This is mostly just a recap from last time.
Just to be sure, so that's taxable income is the gross income minus the necessary expenditures minus depreciation?
Correct.
Okay.
Yes. Yeah. Yeah, so the necessary expenditures and the depreciation are both deductions that you can do to reduce your taxable income. Yeah. Okay. Okay. And so now let's kind of get into a little bit more today. Okay. And so obviously, the goal for most individuals and for most businesses is to pay the least amount of taxes possible, right? Because the less taxes that you pay, the more money that you have on hand, to run your business or to pay for your expenses and things like that. Okay. And so the way that you achieve, or the way that you get to paying less taxes, is that you increase the amount of tax deductions that you make. Okay. And so usually beneficial to maximize tax deductions. And so, your necessary expenditures are your necessary expenditures. So I mean, those are kind of, those are kind of a little bit cut and dry. But the way that we, claim tax deductions from large machinery, these follow the rules of depreciation. Okay. And so, I've been calling them kind of large purchases, or, large machinery, but, the kind of the more formal name for this, at least in economic terms, are capital purchases. Okay. And so capital purchases, these are, you know, large business purchases that generally last more than 1 year. Or I could say that hold value for more than 1 year. Okay. Okay. And so for these large purchases, you know, if you kind of remember from a lot of the previous problems that we did, you know, a lot of these purchases are really, really high, right? So you buy like a new truck or something, that's going to cost you maybe $50,000, right? You buy a new elevator or something, that's going to set you back 20,000, 30,000, right? And so, you know, if you deduct basically the entire cost of a capital purchase up front, you're going to be getting a huge tax reduction. And in a lot of cases, you know, if it outstrips your income for that year, you know, if you have a huge tax reduction up front, then you actually get a tax credit, and the government actually pays you. But this isn't really a fair system, because remember, the idea with these capital purchases is that, you know, they're going to hold value for more than 1 year. So it's not really fair to deduct all that in 1 year, but then you can sell it a year later and get, you know, a ton of money from that. And so, you know, we're going to use this idea that, you know, if you buy a very large purchase, the fact that its value kind of decreases over time, we're going to use that as kind of the basis to form its tax rules. Okay? And I see that there's a question in the chat, and I'll get to it after this. Okay. Okay, so the question in the chat is, but would you want to spend more money initially? Yeah, you would spend a lot of money initially, but then if you can kind of recover that money from taxes, like if you can claim that the entire purchase, like say you bought a $50,000 car or $50,000 truck, right? And then for that year in taxes, you can say, I want to deduct $50,000 from my taxes. Then that's $50,000 you don't have to pay for taxes, right? For that year. Okay. But then what you can do after that is that after you buy that truck, say, you know, after you claim that entire deduction, the next year what you can do is you can sell that truck, and you know, maybe you haven't used it that much because it's just a year, right? And so you sell that truck for $40,000, and so you kind of, you know, do something a little bit shady there, where like you avoid paying $50,000 worth of taxes in the first year, and the next year you sell that truck for, you know, almost the value of what you paid for it. So you kind of skip out on the taxes, and you don't really lose out on that much money. So it's, you know, it's a system that can be really easily exploited. So that's the reason kind of why, you know, we have these depreciation rules, so that the amount that you can deduct from your taxes is more based on how much value that purchase lost over time. And, you know, I'll kind of depict this a little bit more, but yeah, so if the tax rules were like this, then, you know, you would be kind of incentivized to buy a lot at the beginning, so that you can kind of deduct it all from your taxes, and then you can do something with it later on. So we'll get into this a lot more as we do some examples. Yeah, I described that situation, you know, of what you can do, but actually the tax rules are actually kind of like that right now. So these lecture notes are a little bit out of date just because the tax rules have changed. They're kind of always changing, but you know, we'll get more into it. But are there any more questions on this? Okay. Okay, so then that brings us to this idea of depreciation. Okay. And so depreciation, we're going to talk about it in kind of a context of taxes, but depreciation is kind of a more general term. And so depreciation describes how a certain piece of equipment loses value over time. Okay. And so, as a kind of a really quick example, if you've ever purchased a car or you kind of been part of that process before, you know that as soon as you purchase a new car from a dealer, and as soon as you drive it off a lot, that car has lost some value because it's been used, right? Okay. And so you can't, buy a car for maybe like $20,000 from a Honda dealership and then drive it to your cousin's house and sell it to him for $20,000, because as just from the process of driving from the dealership to your cousin's house, the car has lost maybe like $1,000 or $2,000 worth of value. Okay? And so that's the idea with depreciation, that as you use these large equipments, these large equipments that last for more than 1 year, as you use it more and more, and as time goes on, they're going to lose value. But they don't lose all their value at once. So this is kind of a process that takes some time. Okay. 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 And so if I can just kind of draw this kind of visually, just to kind of see. Okay. So let's say that on the x-axis we have time, and on the y-axis we have the value of a certain purchase, right? So let's say that we have a car. Okay. And so let's say that this cost up here, this is the price of this is what you paid for the car. Okay. We'll call this the MSRP of the car. Okay. Or the sticker value, or basically what you paid for. Okay. And then as time goes on, the value of that car is going to go down, right? And so, we can make some markers here for like maybe 1 year, 2 year, 3 year, 4 year, right? So 1, 2, 3, 4, 5, right? Okay. And so all pieces of equipment are like this. So like the airplanes that fly in the sky, the pumps that are used by, by power plants, manufacturing machines, all of these large pieces of equipment will lose value over time. Okay. And so how this relates to taxes is that, when you buy like a car like this with a huge purchase, and you have to pay taxes for this first year right here. Okay. So say it's the end of this first year and you have to pay taxes, what the tax law says that you can't deduct this entire, price of the car right here. Okay. You can't deduct all this from your taxes right here, because this, because over that 1 year, you didn't use up all that value of that car, right? So in reality, over that first year, the only amount of value that you use for this car is given by this amount, okay? Okay. And so what the tax rule says is that, the only thing that you can deduct from your taxes is just the amount that the value of your equipment decreased, okay? And so, if I can kind of sum this up in just kind of one word, is that, if you buy capital purchases or purchase, large equipments for your engineering company, the amount that you can deduct from your taxes over time, you have to do it slowly, because, each year the value of your piece of machinery is going to lose value, and then the amount that it loses value, that's how much you can actually deduct from your tax. Because that's, you can kind of think of that as the money that you spent on the machine that you're never getting back. Okay. Okay. Does that make sense to everybody? Are there any questions on that? Okay. And so let's make one more definition here. So let's make let's define something called the book value. You can kind of think of book value as kind of the current worth of your piece of machine. Okay. Okay. And the way that you can compute this is that you take your initial cost. Okay. So what you paid for the piece of machinery up front. Okay. And then from that, you subtract all the depreciation charges up to that point. Okay. Right. So you can kind of think of the book value as, this is the value that you would sell it at if you, took your object, or you took your machine and you sold it on Craigslist, right? And so let's say that you've driven your car for 5 years. And so over 5 years, it's lost, I don't know, maybe $8,000 worth in value. Okay? And so the amount that you can sell your car on Craigslist is, you just take your initial cost of the car, and then you subtract the $8,000 in value that it's lost up to this point. And then that's going to be its book value. So book value is just kind of a way just to kind of keep track of what's the current value of the car. Okay. Okay. And so, for tax purposes, I really want to pay attention to this value right here, okay? Or the depreciation charges to date, right? Because, when you're computing your taxes and you're performing your tax deductions, the only amount that you can deduct from your taxes is the depreciation charge from that year. Okay. And so when we're doing taxes, when we're doing tax calculations that involve, a large piece of equipment, one of the big steps to doing so is how much has the value of that piece of equipment depreciated over this year. Okay. And we're going to have 4 different methods on which we can compute this. Okay. And we're gonna go over all 4 of these. Okay. And so when I say 4 methods, we're gonna go over kind of the tax version way, or in terms of taxes, how do we compute, how much a piece of equipment changes, the value changes with time. So of course, the actual value of that piece of equipment, it's really going to depend on, what that equipment is, who's the manufacturer, how well it's made. So, the actual value, is actually going to be different. But for tax purposes, we need to compute basically a way to, or we need to compute how much value that piece of equipment is losing over time. And, and so basically the government's kind of come up with some general rules on how to do this just in general. But, in reality, I know that it's not quite the same because, you buy, like you buy like a kitchen knife from, a nice place like Williams Sonoma or something. That knife is going to last a lot longer than a knife you just pick up at like Daiso for $1.50. So, I know in reality, not all kitchen knives and not all pieces of equipment are the same, but at least for tax reasons, we're going to treat them all the same just so that we can apply these general rules to one another. And I know all this is still a little bit abstract right now, but hopefully once we do a couple examples, it becomes a little bit more clear. Okay, so before I turn the page, are there any questions on this? Okay, and so let's go over the first method for computing depreciation, which is one of the most straightforward, which is called straight line depreciation. And so the idea with straight line depreciation is that, we're basically going to assume that your piece of equipment loses a certain amount of value each year, and that amount is the same. Okay? And so we can say that the book value of an asset decreases in a linear fashion. Okay, and so each year we're going to deduct the same amount every year. Okay? And the way that you can compute that is from this formula. Okay? Okay? And so the annual depreciation that you take off is going to be equal to, we'll say I minus S, all divided by N. Okay, where I right here, I is your initial cost. Okay. S is your salvage value. Okay, and N is the number of years that you're going to keep the part. So this is the product life. Okay. And so once you compute this, this amount will be deducted from your gross income every single year. Okay. So your taxable income is going to be reduced by this amount. Okay. And so we're going to do an example next, but what you'll see for these examples, when you're doing these tax calculations, it's really helpful to draw an after-tax cash flow table. Okay. And so it might be a little bit hard to fit into this small iPad, but this is typically how I do it. Okay. And so in the first column, we're simply just going to keep track of the year that we're in. Okay. Okay. So that's the first column. The second column will be our before tax cash flow. Okay. And so before we apply any taxes, that's the cash flow that we'll have. Okay. Next, we'll have our depreciation. Okay. Or basically, the depreciation that we're gonna compute, which is gonna be, which we're gonna deduct from our before tax cash flow. Okay. Next, we're going to have a column for taxable income. So we're going to compute the amount of money that's going to be subject to taxes. Okay. Next, we're going to have a column for taxes. So this is actually the amount that we're going to pay for taxes. Okay. Okay. And then our final column over there will be our after-tax cash flow. And so after we paid our taxes, this is how much money we're actually going to pull in. Okay. And so it's a little bit cumbersome, and I know it's a little bit annoying to write these tables, but for these tax calculations, especially once the calculations get to be more complex, it really pays to be a little bit organized in how you're computing this. Okay. All right, are there any questions on this before we jump into an example? Okay. Okay, so let's do an example just to see how it's all kind of put together. Okay, so let's say that your company recently purchased a new truck and it was $50,000. Okay. And so it's expected that you're going to use the truck for 5 years. Okay. And in each of those 5 years, it's expected to produce $20,000 in revenue. Okay. And then at the end of 5 years, you can salvage the truck or you can sell it for $10,000. Okay. And so if we assume an interest rate of 10%, and then a federal tax rate of 21%, assuming those things, let's compute the after-tax present worth of this truck. Okay. And then to depreciate the value of the truck, we're going to use straight line depreciation. Okay. Because this truck right here, you can see that we're spending $50,000 on it. So this falls under the category of a capital purchase. Okay. And so we'll eventually be able to deduct this the value of that truck over the time that we use it, but we can't do it all up front. And so remember, the amount that we're going to depreciate each year is going to be based on how much value that truck is going to lose each year. Okay. Okay. So first thing to do, just for comparison, just so that you can kind of see, how much impact the taxes make. Let's compute the present worth, as we usually do, before, without considering any taxes. Okay. And so this is our present worth with no taxes. Okay. So we'll set this up. So we have our initial cost of $50,000. Okay. So we have a minus 50,000. Okay. We're going to add in our revenue. So our revenue is 20,000. And since this is present worth, we're going to do P over A. Okay. Our interest rate is 10%. And then our time period is 5 years. Okay. And then to this, we're going to add the salvage value. So it's going to have a 10,000, P over F, 10%, and 5. Okay. And so we compute, we perform this calculation, and what we get is 32,029. Okay. Right. And so what we're going to do is, once we compute the after-tax present worth, we can compare it with this number to see how much impact the taxes are making. Okay. And so now that we compute the before-tax present worth, just for comparison, let's launch into, our after-tax calculation. Okay. And so our first step is going to be to compute, how much our depreciation is going to affect our taxable income. Okay. And so since we're using straight line depreciation, let's compute the depreciation charge each year according to this formula. Okay? And so first we have our initial cost. Our initial cost is 50,000. Okay? From that, we're going to subtract our salvage value. So our salvage value is 10,000. Okay? And then we're going to divide by 5, which is the number of years. Okay? And then what we compute from this is 8,000. Okay? And so what we're basically saying is that this $50,000 truck is going to lose $8,000 worth of value each and every year. But because our truck is losing that value, we can deduct that from our taxes so that we can pay less taxes. Okay. Okay. Any questions on this? Okay. Okay. So let's construct our table like we did before. Okay. And so our first column here is simply just going to be the years. Okay. And so just to make sure it all fits, I'm going to abbreviate it. Okay. Okay. So we have 5 years here. So we have 0, 1, 2, 3, 4, 5. Okay. So this second column, which I'm struggling to write because it's right underneath the freaking button, is our before tax cash flow. Okay. I hate the stylus so much sometimes. Okay. And so before any taxes, that's the cash flow that we're going to have. Okay. Okay. And our next column here is going to be our depreciation. Okay. Our next column is going to be our taxable income. Okay. Our next column is going to be the taxes that we pay. Okay. And then the last column will be our after-tax cash flow. Okay. Okay. And so let's write in our before tax cash flows because we know all of these already from the problem. Okay. And so in the first year, we're going to spend $50,000. And so the way that we do this, we're going to just do a minus 50,000. Okay. And then in each year after that, we're going to make a positive 20,000. Okay. Okay. And then in the fifth year, because we're going to be salvaging our truck, we're going to add an additional 10,000. So this is going to be 30,000 per year. Okay. So that's before taxes. So we've kind of already did those calculations, and so now we're going to do the rest for for our after-tax calculations. Okay, and so first let me fill in kind of this first row. So in this first row is year 0. And so in year 0 here, we actually haven't made any money yet. Okay, so remember when we're talking about taxes here, we're strictly just talking about income taxes. So it's only taxes on the money that you make. So in the first year, since you didn't make any money, you just purchased the truck. You know, we're not going to compute any taxes there. So the first row of your tax tables, which for year 0 is always just going to be you're going to have your initial cost, but then you're not going to have anything else there. Okay, so everything else is going to be blank. Okay. And so let's do the full calculations for the first row, just so you can kind of see, you know, how that is, and then I'll kind of fill in the rest of the table kind of quickly. Okay. Okay. And so our next column is our depreciation. So we computed that on the previous page. Okay. And so from the previous page, we know that the value of our truck is going to depreciate by $8,000 each year. Okay. And so let's go ahead and write down 8,000 here. Okay. Because that's the amount that it's going to depreciate. Okay. And so now let's start talking about some of the other columns. Okay. So taxable income. So taxable income, the way that you're going to compute this is you're going to take your before tax cash flow. Okay. And you're going to subtract your depreciation for that year. Because remember, your depreciation charge is simply just a tax deduction, right? And so since our truck lost $8,000 worth of value, we can take that 8,000 and we can deduct it from our income. Okay. And so for this first year right here, we're going to take 20,000, which is our before tax cash flow, and then we're going to subtract the $8,000 deduction from the depreciation. Okay. And so our taxable income here is just going to be 12,000. Okay. So we just took 20,000 minus 8,000. Okay. And so to compute our taxes, you know, what we're going to do is we're going to take our taxable income and then just simply multiply it by the tax rate. So in this case, we have a taxable income of 12,000. Okay. And so if we multiply that by 0.21, we get a tax of 2520. Okay. Right. If you compare this to, you know, let's say you take your original 20,000, you multiply by 0.21, you know, if it weren't for the depreciation, you'd be paying $4,200 of taxes, you know, this year. Okay? But because we have our depreciation and the fact that our truck lost some value, you know, we can deduct that amount from our taxes so that we end up paying a lot less. Okay. Okay. And so after we do that, now that we have our taxes, we can compute our after-tax cash flow. Okay. And so the way that we can do this is we take our before-tax cash flow, and then we subtract our taxes. Okay. So in this case, we have 20,000, and we're going to subtract 2,520, and then what we're left with is 17,480. Okay. Right. So does that make sense? How we kind of filled in each of these columns in the table? So all these different columns kind of make sense to everybody? Okay. Okay, so I'm going to go ahead and fill in the rest of the table then, just so you guys will have it. Okay. So with straight line depreciation, remember each year our depreciation charge is going to be the same. So I'm just going to fill in $8,000 each year. Okay. And so our taxable income is going to be 12,000 for years 1 through 4. But in year 5, because we salvaged the truck, we're going to do 30,000 minus 8,000, which is going to be 22,000. Okay. And then our taxes will be the following. And then in the last year, it's going to be 4620. Okay.
Wait, to get the taxes, do you multiply 12,000 times the federal interest rate?
Yes, yes, correct.
Okay.
Mm-hmm. Okay, and then for the last year, we have 25,380. Okay. Okay. And so, you know, the goal for any time tax calculations is this final column right here. So after you paid your taxes, basically you want to find out how much money that you're actually going to bring in. And so from here, you know, from this last column, we can actually compute the present worth. Okay. And so after taxes, our present worth is going to be our minus 50,000. So our initial cost doesn't change. Okay. Now, instead of a uniform series of 20,000, we have a uniform series of 17,480. Okay. Because that's the that's after we paid our taxes. Okay. So this is P over A, 10%, and 5. Okay. And then to that, we're going to add our additional salvage value at the end, which is going to be 25,380 minus 17,480. Okay. So it's going to be plus 7,900 P over F, 10%, 5. Okay. All right. And then we can compute our after-tax present worth. It's going to be 21,171.79. Okay. And so after we take into account for taxes, you know, our present worth is only going to be $21,171 dollars and 79 cents. Okay. And so you can see if you compare it to our before tax present worth, our before tax present worth was $32,029. Okay. And so this is a lot less. So you can see taxes make a pretty significant impact on, you know, how much of you know, what you compute to be like your present worth or your annual cash flow analysis. Okay. And so, you know, up to this point, we've been just ignoring the taxes, but you know, they make a pretty significant impact. So it's you know, it's really important to compute this for your stuff. Okay.
Professor?
Yep. Mm-hmm.
Can you go over again where you got the 7,900 from?
Yeah, so the 7,900, the way I computed that was I basically took, that was basically for this last year right here. Okay? And so this last year, you know, because we salvaged, you know, we made an additional amount on top of our 17,480, right? And so that 7,900 is 25,380 minus 17,480. And this is 7,900 right here. And so that's kind of an additional amount that we get from salvaging on the last year.
So what this tells us is that the truck is worth less after tax?
Yes. Yes. Mm-hmm. Yeah, which makes sense because, you know, you're paying, you know, you're not making the full $20,000 each year from this truck because you have to pay some of that in taxes because that's income tax, right? So any money that you make, you have to pay to the government in taxes. Right. So, you know, I'll be kind of the first to say that these tax calculations can be pretty tedious because it's, you know, we did, you know, this by comparison is a fairly simple example, but like once you start factoring a lot more things, you know, you're gonna have more columns on this table and you can have more rows too. So I know tax calculations are pretty tedious and it's really easy to kind of make just kind of a simple math error along the way. So you really want to be careful. You really want to be organized for these calculations because it's, you know, it can be really easy to make a mistake. Yeah. All right, any final questions on this example? Okay. Okay, so that's the basics of kind of taxes and depreciation. Okay, so you can see it makes a really big impact. But you know, I think let's before we kind of move on to the other depreciation methods, let's talk a little bit more about, you know, what types of purchases constitute a large capital purchase. Okay. Or in other words, what constitutes or what type of purchase is eligible for depreciation? Okay. And so, you know, according to the tax rules, you know, there's kind of three different you know, characteristics that a purchase must have. Okay. So let's go over the three of them. Okay. And so the first thing is that the asset that you buy, it must be used for business purchases to produce income. Okay. And so, like a computer that, that you might buy that, you're just going to use for gaming, unless you're a Twitch streamer, unless, you make money off that stuff, that kind of purchase is not eligible for depreciation because, it's not being used, it's only being used for fun. So it's not being used to produce income. Okay? But with, how flexible things are nowadays, this is, you can kind of justify this for almost anything as long as you kind of use it for money. But that's kind of just kind of the base requirement for a depreciable asset. Okay. And so the second condition is that the asset must have a useful life. Okay. So it can't last forever. And this useful life must be able to be determined. Okay. Not only does it have to be determined, it has to be greater than 1 year. And so finally, the third condition is that this asset must be something that either decays, it gets used up, it wears out, or becomes obsolete. Okay? Or in other words, it has to be something that actually loses value over time. I'm not saying that you can't be a Twitch streamer. It's just that if you are, then you can take your computer and you can deduct it from your tax. The cost of your computer, you can deduct it from your taxes because it fits all these criteria, right? So don't give up on your dreams. Okay. And so, for most machinery that you're going to purchase, as an engineer, a lot of them fall under these categories, right? So you think of, we did an example with the truck last time, but you can think of like airplanes. You can think of like, manufacturing machines. You can think of, anything that might be in the machine shop, computers, servers, all of these things, none of them last forever. And they all cost a huge amount, right? And so most of the equipment that you are interested in using as an engineer, fall under these categories, okay? But I kind of want to lay out just these three categories just kind of explicitly because these are kind of the criteria that's used for these kind of tax purposes. Okay. Okay, so that's that. Okay. And so now let's move on to the next type of depreciation, which is called declining balance depreciation. And so declining balance depreciation, we've gone over what's it called, straight line depreciation, where the depreciation charge is the same every single year. What the declining balance depreciation says is that the way it works is that it applies a constant depreciation rate. Okay. Okay. And this rate that we're going to compute is going to be based off the book value of the piece of machinery. Okay. And so the formula for it, so I'll define this variable dt. So d sub t, that's the depreciation charge for this year. Okay. The way that we compute it is we take 2 divided by n times the previous book value. Okay. And so basically the amount that we depreciate each year is, we're just going to take, how much of the, how much it's currently worth, and then we're just going to reduce it by a certain percentage. Okay. And so that rate that I talked about is this guy right here. So this is the rate at which we're reducing it each year. And then, as you can see, that's based off the book value. And so, you might be asking, why do we have a 2 right here? So this 2 kind of seems kind of random. And so, 2 is just kind of the standard way that people have used, and that it kind of matches up with how certain pieces of equipment, they lose value over time. But sometimes for certain types of industries, you can have a 1.5 here as well.
Professor?
Yeah.
Can you read out that formula? Does that
Yeah.
say D sub T?
Yeah, it's d sub t is equal to 2 divided by n. So n here has the same definition as before. So n is the number of time periods that you're going to consider. Okay. Or you can kind of think of it as the life of the product. 2 divided by n times the previous book value. So the previous book value is kind of you can kind of think of it as how much your asset is worth in the previous year, and then you're just going to multiply it by a constant decimal here in this case. Yeah.
Okay, thank you.
Yep. Okay. And so what I'm going to do on the next page is I'm going to redo our previous example, but instead of straight line depreciation, I'm going to use declining balance. Okay. Before I do that, are there any questions on this?
Professor?
Yeah. Mm-hmm.
Oh, can you re-explain the 2?
The 2. So the 2 is it's a number that kind of determines the rate. So you can kind of see from here that if you have a higher number than 2, your depreciation is gonna decay a lot faster. So the 2 is the reason it's used is because this is after it's kind of been tested across lots of different industries with automotive industry, aerospace industry, electronics. 2 seems to fit the most in terms of how quickly certain things decline. And you'll kind of see that kind of in the example. But for certain kinds of industries, you might change this to be something like a 1.5, or sometimes you can be higher than that too. So most of the time, 2 is a pretty good estimate, but depending on your industry and depending on kind of the standards that they use there and the kinds of equipment that you consider, you might use a different number there. But 2 is kind of standard, and it's kind of a good medium for most places.
All right, got it. Thank you, Professor.
Yeah. Okay, so let's redo our example, and instead of straight line, let's use declining balance. Okay, and so I'm not going to rewrite all the stats, but I'll write just the kind of the most important ones. And so from the previous example, we know that we purchased a truck for $50,000. Okay. Our revenue each year is 20,000. Okay. And our salvage value after 5 years is 10K. Okay. And so if we assume what interest rate? 10%. Okay. Tax rate is 21%. Okay. Let's compute the after-tax present worth. But remember, instead of straight line depreciation, we're going to use declining balance. Okay, so the first thing that we need to compute when we do declining balance is we need to compute, what's the rate at which we're going to decline our value. Okay, and so that rate is going to be computed by what I have circled in red right here. So we're just simply going to take 2 and we're going to divide it by n. Okay, and so in this case we have an n of 5, right? Because our truck is going to last for 5 years. Okay. And so each year, we're basically going to depreciate 40% of our current book value. Okay. Okay. And so I'm going to write our tax table again, but I'm going to expand it by 1 column. So the additional column that I'm going to add is for the book value. So we didn't need that in the previous problem because our depreciation amount was the same every year. But since our depreciation now is going to depend on the current value of the truck, I'm going to add that column there just so we can kind of keep track. So it's going to be a tight squeeze on this tiny ass iPad, but we'll do our best. Okay. And so our first column, just like always, is going to be our year. Then we have our before tax cash flow, so that's our BT cash flow. Okay. Okay. Next, we have the amount that we're going to depreciate each year. Next, we have our taxable income. Next, we have taxes. Okay. Then we have our after-tax cash flow. So this is AT cash flow. Okay. And then this last column that I can barely squeeze in will be BV. So BV is going to be our book value. And so remember, the book value is just going to be simply the current value of our truck. Okay, so let's write in our years. Okay. Let's write in our initial cost. So our initial cost here is 50,000. Okay. Remember, we don't pay taxes on the first year because we just purchased the truck, and so we're just going to leave dashes in there. So it's they're going to be all blank. Okay. And so at the initially, our book value is simply just going to be the initial cost of our truck. And so we have a book value of $50,000 at the end of right after we purchase it, right? And so we had just handed over the check to the truck dealer, and then now we have the truck, so our truck is worth $50,000. Okay. And so I'm going to go ahead and fill out the first column the second column for before tax cash flow, since we know all these already. Okay. And so each year we're going to make $20,000 and then an additional $10,000 at the end. Okay. Okay. And so now let's compute depreciation, because this is going to be our biggest difference here. Okay. And so just like we saw on the previous page, the way that we're going to compute this is we're going to take our depreciation rate. So our depreciation rate here is 0.4, and we're going to multiply it by our previous book value. And so in this first year right here, our previous book value, which is just basically just the initial cost of our truck, is $50,000. Okay, and so our depreciation here is going to be 50,000 multiplied by 0.4. Okay. Okay, and so we take 50,000 multiplied by 0.4. What we get is 20,000. Okay. And so what that basically is saying is that under the rules of declining balance, our truck has lost $20,000 worth of value in that first year. Okay? And so, since our truck lost $20,000 worth of value, we can take this and we can deduct it from our cash flows. Okay? And so in this case, we've made $20,000 in revenue in the first year, but our truck also lost $20,000 worth of value. So $20,000 minus 20,000 is just 0. Okay? And so we have no taxable income. So we have no taxable income. We don't pay any taxes. Okay? Okay. And then our after-tax cash flow, since we didn't pay any taxes in that first year, is just going to be $20,000. Okay. And so the last thing that we have to compute after the first year is our book value. So remember, the way that we can compute book value is we take the initial cost of our asset and then we subtract all the depreciation charges to date. Okay? Or in other words, the way that you can compute it in terms of this is you can take the previous book value, okay, and then you can subtract the depreciation charge for that year. Okay, and so let's compute that for this this first year right here. Okay, and so our previous book value, all we have to do is we have to look at just the row right above it, and so we can see that our previous book value was $50,000. Okay, and then from that we're going to subtract our depreciation charge for that year. Okay, and so since our truck lost $20,000 worth of value, the book value is now going to be $30,000. Okay, all right. So that kind of makes sense how we computed, everything in this in that year one row.
Yes.
Oh, okay. Okay. So let's do the next row together. Okay. And so for the next row, our depreciation is going to be 40% of the previous book value. Okay. And so our previous book value is 30,000. And so in order to compute the depreciation, we take 30,000 multiplied by 0.4. And that gives us 12,000. Okay. All right. And so in the second year, our truck will lose $20,000 worth of value. And so we don't have to pay that in taxes. So our taxable income will simply just be 20,000 minus 12,000, which is 8,000. Okay. And then we take 20% of that, 21% of that 8,000, we get 1,680. And then we compute our after-tax cash flow, which is our 20,000 minus our taxes paid, which is 18,320. Okay. Right. And then after that, we can compute our book value. So our book value is going to be our previous book value minus the depreciation that year. So we're going to take 30,000 minus 12,000 here, and so we get 18,000. Okay, and so we can continue this pattern. So I'm just going to fill in the rest of the table just so you guys will have it. Okay.
Can you say again how we get 8,000?
This 8,000 right here, or the
one and then the BU
yes. So this
last column.
Right. So this should be 18,000. Sorry, it kind of got overlapped. And so the way that we got 18,000 was we took the previous book value, so the book value from the previous year, which is 30,000 right there, and we subtract the depreciation for that year, which was 12,000. So we did 30,000 minus 12,000, we got 18,000. Yeah.
Thank you.
Mm-hmm. 2688. This is 17,312. This is 10,800. So this last year is 4,320. Okay, 15,680. 3292.8. 16,707.2. 6,480. Okay. And then last year we have 2,592. 2,7 408 5755.68 and 2424432. Okay, this is 3888. Okay, and so that's the after-tax cash table for cash flow table for the same problem but with declining balance. Okay, so now that we have all these after-tax cash flows, we can basically take these and compute the present worth.
Is that 24,000 after on AT cash flow?
Yes, so that's 24,244.32. Yeah. Okay. Any questions on this? Okay. And so what we're going to do now is we're going to take everything that's in that last column there and then use that to compute the present worth. Okay. And so unfortunately, you know, because we used a different depreciation rule, all these numbers here are a little bit awkward. So it's a little bit, it's really difficult to put like a uniform series on this because the amount changes every single year. So you can try to fit it to like a gradient and a uniform series, and you know, I think for these problems, it's a lot easier to just kind of take each of these costs as just a single sum in the future and then take those back to the present day. So let me show you kind of what I mean by that. Okay. And so the present worth for this will be, we're going to start with the initial cost. We're going to start with 50,000. Okay. To this, we're going to add our after-tax cash flow for the first year, which was 20,000 here. Okay. So 20,000 P over F. 10%, and since this occurs in year one, we're going to add a +1 right there. Okay. Next, we're going to add the after-tax cash flow for year two, and so that's 18,320 P over F, 10%, and 2. Okay. Next, we're going to add the after-tax cash flow for year three, so this is going to be a plus 17,312 P over F. 10% and 3, okay, plus 16,707.2 P over F, 10% and 4, okay, plus 24,244.32 P over F, 10% and 5. And so we perform all this arithmetic, and what we get is 22,792.47. Okay. Okay. And so if you compare this number to our after-tax present worth from straight line, you know, you'll see that this is slightly higher. Okay. Okay. And so, you know, before we close for today, you know, I just want to kind of leave you just with one thought. Okay. And that's, you know, that kind of has to do with explaining why this depreciation is slightly higher, or why this present worth is slightly higher. And so in order to do that, I think some people are still writing this down, so I'll stay here. What I want you to notice, if you compare our depreciation charges for the declining balance versus the straight line, what you'll see is that we depreciated much more early on. Okay. And so if you compare just the first year, so our first year of straight line depreciation, we only depreciated 8,000, but for declining balance, we depreciated 20,000. So that's a big difference. Okay. And so what this tells us is that it's usually more economically advantageous to depreciate more early on. Okay. And so the term that I use for this is, I call this aggressive depreciation. And so basically, you know, the more that you can depreciate early on, you know, the more the cost of your machine that you can depreciate, the more tax deductions that you get early on, you know, that's going to be better for you in the long run. Because remember, you know, money is more valuable for you to have sooner rather than later. Because the more money you have now, you can use that for more purposes than if you had it later. Okay. And so the way that works with depreciation is that, you know, if you can depreciate more of your cost early on, so you can say that, let me front load all my depreciation, then that's going to lead to more money for you on hand now, and it's going to maximize the economic value for your assets. Okay. Okay. Any questions on this?
In an exam, is one method better than the other?
Or in the exam, I'll tell you which method to use, because usually it's the law that basically determines which one that you end up using. And so these are kind of the methods that's been used kind of in the U.S. for, you know, the past, you know, few decades. And so we're going to learn all of them, but depending on, you know, it depends on the administration, depends on the tax laws at the time, you know, that usually determines which one that you actually use. Yeah.
Okay, thank you.
Yeah. Mm-hmm. Okay, so we'll pick this up on Thursday. So thank you everybody for tuning in today. You know, if you have any more questions, you know, I'll stick around for a little bit, and then there's office hours after this. But if not, I'll see everyone on Thursday. So have a great day, everybody.
Thank you, Professor. Have a great day.
Thank you. You too.
Have a good day, Professor. Thank you.
Thanks. You too.